Hi everybody, this is Dr. Wright. So lately in class we've been talking about the capital asset pricing model, and we've been talking about how the capital asset pricing model allows you to answer two really important questions. The first question is, how much should I expect to return if I invest in a specific asset? And the second question is, how can I determine whether or not a specific asset or a portfolio manager is generating returns outside of the systematic risk that's inherent in the asset or the systematic risk that the portfolio manager is bearing? In short, the capital asset pricing model allows you to determine how much return you should expect given a certain level of systematic risk, and it also allows you to assess whether or not an asset or a portfolio manager is generating significant returns outside of the systematic risk. And so let's dive right in. What I want to do today is I want to show you how to estimate beta, since beta is such an important part of the capital asset pricing model. And then I want to show you how to assess whether or not a portfolio manager is generating significant returns outside of the systematic risk that he or she is bearing in the portfolio. Let's begin by reviewing very briefly the capital asset pricing model. The capital asset pricing model says that the expected return on an asset, which I'm just labeling I, it could be Walmart, it could be a mutual fund, but the expected return for an asset or a portfolio is the risk-free rate plus the product of the asset or portfolio's beta times the equity risk premium. So what's the theory behind this? The theory behind this is that A, the only type of risk that should be rewarded is systematic risk. That systematic risk is best quantified by this beta. And so if you want to figure out how much an asset or a portfolio should realize in terms of return, what you want to do is begin with the risk-free rate, and then you want to add a risk premium. And the risk premium should be based on the average risk premium for bearing average systematic risk. So that's the equity risk premium. It's the premium above and beyond the risk-free rate. Why above and beyond the risk-free rate? Because you've already considered it. You've already considered the risk-free rate, so we want to know the reward for bearing average systematic risk. So there it is. That's the average reward for bearing average systematic risk. And then we scale that average reward for bearing average systematic risk by the specific systematic risk of the asset or the portfolio. So that's the theory behind CAPM, but how do we estimate beta, and how do we answer this question of whether or not a portfolio or an asset is generating abnormal returns? We have to turn CAPM into a single variable index model, and the way that we do that is as shown below. So instead of using expected returns, we use historical returns. And what we do is we grab this risk-free rate and we throw it on the other side of the equation, and then we estimate a regression. So what we do is for every period in our sample, so it could be the last 5 years, so maybe you're looking at monthly returns over the last 5 years. If you're looking at monthly returns over the last 5 years, then what you would do is every month the first step is to go and get the return to whatever asset or portfolio you're studying. So that's your RIT. So that's just your return to your asset or your portfolio every period over your entire sample period. That's where you begin. The second step is to get the risk-free rate in all of those periods. So in every one of those 60 months, you would go and get the risk-free rate. And then what you would do is find the difference between the return to the asset or portfolio and the risk-free rate. That will be the Y variable, the dependent variable in the regression equation. Next thing you need is an X variable. The X variable is the equity risk premium every period. So if you were doing the last 60 months, every month you would go and get the return to the market and subtract out the risk-free rate. That would be your X variable, your independent variable. So you would have two data series. You would have your Y variable, your X variable. You would estimate the regression, and the regression would spit out these two what we call parameters. It would give you an alpha and a beta. Now, since we moved the risk-free rate onto the left-hand side of the equation, there shouldn't be an alpha. In other words, ex ante or a priori, we expect that the alpha will be zero. That's what we anticipate. Anything other than a zero alpha would mean that there are returns being generated that have nothing to do with the systematic risk. Now the beta is the other parameter that's going to be estimated in the regression, and that beta literally represents the systematic risk that we believe exists in the asset or the portfolio. Now why is that? That beta, in a very real sense, measures the scaled correlation between your y variable and your x variable. In other words, it's how closely this variable tracks this variable. If it tracked perfectly, it would be a beta of 1. If it tracked with greater intensity, what I mean by that is if this variable went up a little bit and this one went up a lot, or this variable goes down a little and this goes down a lot. So if you have higher intensity, then this would be above 1. If you have lower intensity, so if this variable goes up a lot and this one goes up a little bit, or this one goes down a lot and this one goes down just a little bit, then you'd have a beta less than 1. You can also have a negative beta. Negative beta would mean this variable goes up, this variable goes down. So that's what you're going to see in the regressions. And so let's jump right into it. I thought it might be interesting for us to do this for Berkshire Hathaway. Berkshire Hathaway is the holding company that's managed by Warren Buffett, probably the most famous investor in the history of the stock market. And you can see that right now to buy one of his A shares is quite expensive. What I want to do is I want to estimate this regression, figure out what the beta is for Berkshire Hathaway, and then I want to talk about this alpha. So let's get a history going back about 10 years, and I'm going to use a spreadsheet tool that I have. This spreadsheet has a macro in it. I did not develop the macro. I found this online and just did some small tweaking and modifying to make it do what I want it to do. But all I have to do is put in BRKA, give it a start date. I'm going to give it a start date of 12/31/2000, and I'm going to give it an end date of 12/31/2011. And then if you just go and view the macros, you can see there's only one macro, and if you run it, then you will see that this macro goes and scrapes Finance Yahoo and pulls in the closing prices for Berkshire Hathaway over the sample period that we put in. I'm going to start by saving this as something other than the template because I don't want to disturb my template. I like my template the way it is. Okay, I've saved this, and now what I want to do is I'm going to resort it from oldest to newest. So I'm just sorting the data based on date, and there it is. Now, I want to point out that this data right here is not actually the price on January 2nd of 2001, just like this is not actually the price on December 1st of 2011. So you can see right here that it says that the price as of December 31st, 2011 was $114,755. I'm going to demonstrate to you that that's not accurate. So let me take this to December 30th of 2011, and you'll see that actually that price of $114,755 is actually the closing price on December 30th, not December 1st. So these are actually month-end closing prices. That's going to matter here in just a second. So let's go ahead and calculate the return to Berkshire Hathaway because we're going to need that. Give it just a little bit of formatting TLC. And the way that we're going to get returns is we're going to take the log of the ratios. We're going to use continuously compounded returns like we did in previous assignments. So we just take the log of the current price over the previous price, close up the parent, send that all the way down, turn it into a percent with a few decimals, and we are on our way. Now the next variable that we need is the risk-free rate. And if we get the risk-free rate, then we can calculate the return to Berkshire Hathaway minus the risk-free rate. And forgive me for just a second as I go back in and do a little bit more formatting. So we're going to need the risk-free rate so that we can get the difference between the return on Berkshire and the risk-free rate. And we're also going to need the return on the market minus the risk-free rate. The way that we're going to get that is we're going to go to the Ken French Data Library. If you just go to Google and you Google Ken French Data Library, you can see it pulls up. And down here, so just scroll down a little bit and you can see Fama French factors. So pull that up. Now the problem is this is going to pull up as a text file. So open it up, save it, and then what you need to do is open it back up in Excel. So go back to your Excel file, and we want to go find this. So open up the folder where you saved it. And one trick is you need to come down here and choose all files. Oftentimes the default is all Excel files and you won't see it. Pull up all files and now you see it. Click on the Fama French Research Data Factors, open it up. You can actually click right through this. It just asks you how you want it formatted. Click through it and you can see it looks good. Now, one thing to notice, actually two things to notice. So this data set contains the risk-free rate every month, which is fantastic, and it contains the market or the equity risk premium, the market risk factor every month. That's fantastic for us. Problem is these are in integer format, not in decimal format, so when we import them, we're going to need to divide by 100. And also notice that the date format is very unique. This data set formats the date as year and then month. So I'm going to come over to our Excel file and I'm going to create a second date column right here. And I'm going to format these dates congruent with what we saw in the FAMA French data set. So how I'm going to do that is I'm going to take the year of this date, multiply it by 100, and add the month of that date. If we do that, it should create what we want. It's going to have a minor formatting problem, so we'll come in and we'll format it as a general number, and that should solve our problem. Click that all the way down, and once we have that, we can actually hide a lot of this other information that we don't need. Okay, so first thing, let's go get the risk-free rate. So we're going to do a VLOOKUP, and what we're going to look up is this date. We're going to look it up in the other Excel file in this array, and notice that we're going to want the fifth column. So we're going to look up the date in the first column, but we're going to want to pull the fifth column. So we're going to have to tell it that. We give it a comma, and then we tell it to pull from the fifth column, and then I'm going to tell it false for our logical test. That just means we want an exact match. If we cannot find the date, don't give me any output. We do that, and we need to divide by 100 to turn it into a decimal. Send it all the way down the line. Turn it into a percent. Give it a couple decimals, and once we have that, we can take the difference. We can take our return on Berkshire Hathaway minus our risk-free rate, send it all the way down the line. So that's going to be our Y variable in our regression. Next thing we need is the market risk premium, the equity risk premium. Okay, so we need the equity risk premium every month, so we're also going to do a VLOOKUP just like we did previously. And we're going to look up this date in this array right here. But now we don't need to go all the way across. We just need to go to this second column because that's where our equity risk premium is. So we tell it to pull from the second column. Again, we give it the false logical test. That way we only pull the data if we have an exact match. And we need to divide that by 100 as well. Send it on down the line. Turn it into a percent with a little bit of formatting TLC. Okay, so the first thing we want to do is just calculate some summary statistics to get a feel for what's going on a nominal or raw basis. So let's just calculate the mean return and the standard deviation. And we'll do this for the return on Berkshire Hathaway minus the risk-free rate and also for the market minus the risk-free rate. So let's go ahead and calculate the average for Berkshire Hathaway minus the risk-free rate, and we'll get the same for the market minus the risk-free rate, and we might as well annualize it, so just multiply it by 12. And let's calculate the standard deviation, and let's do the standard deviation of a population for Berkshire Hathaway. And remember, to annualize that, you would multiply it by the square root of 12 as we've done in previous assignments and turn those into percentages and format it just a little bit. Okay, so let's just take a peek at this on a raw basis here. If you look at the average annual return to Berkshire Hathaway over this roughly 10-11 year period, minus the risk-free rate, you can see the Berkshire Hathaway is at about 2.8% per year. The market's at about 1.8% per year. They both have relatively high standard deviations. There's quite a bit of bounce. We could do a 95% lower bound, and we could do a 95% upper bound. And so that would just be the average minus 3 times the standard deviation, and it would also be the average plus 3 times the standard deviation. Don't really need that many decimals, so let's give it some formatting help. And we can copy and paste that across. So you can see, just formatting it here real quickly, pardon me. So let's just do a little comparison before we estimate our regression. So Berkshire Hathaway's beating the market by about 1% per year. It's got about the exact same standard deviation. So it actually looks very, very similar to the market as we just look at the raw statistics, although Berkshire Hathaway seems to be outperforming by about 1% per year, which that's a substantial amount. 1% per year would make a difference in a portfolio over the long run. So now what we want to do is I want to estimate the beta, see what Berkshire Hathaway's beta is, and I also want to take a peek at their alpha and see if they are in fact generating some positive significant returns that have nothing to do with systematic risk, which would be impressive and would be a positive thing if you're an asset manager with Berkshire or if you're a Berkshire investor. So going back to our regression, we've already figured out our Y variable, the difference between Berkshire and the risk-free rate. We have our X variable, which is the return to the market minus the risk-free rate. We just need to estimate our regression and get our alpha and our beta. So let's go ahead and do that. We go to Data, Data Analysis, Regression. And so for our Y variable, we want to just highlight the Berkshire Hathaway minus the risk-free rate. And for the X variable, it's the return to the market minus the risk-free rate. And we're going to go ahead and have this get spit out on a new worksheet. And so here's our results. And so how do we interpret this? Well, here are the numbers that we're going to focus on right here. So let's highlight those so that we can get into them. Okay, so first off, we wanted to estimate beta. And beta is the coefficient on the X variable. It's the coefficient on the X variable. You can see that this is our X variable, and that's our coefficient or our slope coefficient. So that's our y-intercept, that's our slope coefficient on our X variable. So there is beta, has a beta of approximately 0.3865. Remember, a beta of 1 means that you have average systematic risk. A beta of less than 1 means that you have less than average systematic risk. It has an, and by the way, we should also look at the t-statistic, and I'm going to the p-value. You can see that the p-value is incredibly small. How do we interpret this p-value? Well, p-values have to do with the idea that we're looking at a sample, but we're trying to make inferences or statements about the population. So we've run a regression using a sample. What this p-value says is we don't know the beta of the population, but if the population beta were truly 0, then the probability of grabbing a random sample from that population, estimating a regression, and getting a coefficient that big for your beta is that small. In other words, there is almost no chance that we grabbed a sample from a population that has a beta of 0. What we're saying is this: we don't know if that's the right beta, but we're pretty sure that you would never get a beta that big if the true population beta was 0. They actually calculate an upper and lower 95%. In other words, we're 95% sure that the beta lies somewhere in this range. You can see the range is between 0.23 and 0.55. So it may not be 0.38, but it's definitely positive, and it's probably definitely below 1. So it's got a positive beta, but it's a below 1, significantly below 1. All right, let's start looking at this alpha. Now remember, from our regression, since we moved the risk-free rate onto the left-hand side, we expect the alpha to be 0. But we don't see a 0. We see an alpha that's a positive 17.3 basis points. So they have a positive alpha, but here's the problem. It's actually got a pretty low p-value. So how do we interpret this? Well, we don't know what the alpha is, but we can say this. If the population alpha were 0, and we grabbed a random sample that's the same size as our sample, so if the population alpha were 0 and we grabbed a random sample and we ran a regression, there's a 66% chance you could get an alpha this big in your regression, even if the population alpha is 0. This plays out because you can see that the confidence interval goes from negative 0.61 to positive 0.956. So what does that mean? We don't know the true alpha, but there's actually a pretty good chance that the alpha could be 0 or negative. So we cannot say that Berkshire Hathaway has generated a positive and significant alpha. How do we interpret this? Well, Berkshire Hathaway has modestly beat the S&P 500 every year, or on average over the last 10 or 11 years. So it's, in a modest sense, beat the S&P 500. Really, not much of it has to do with systematic risk. It's only got a beta of 0.38. However, we cannot say that they're generating any sort of statistically significant returns outside of the systematic risk. Let me interpret one other variable here because it's important. The R squared is 14.6%. What does that mean? What that means is, if you look at both of these variables, they both have significant standard deviations. I shouldn't say significant, I should say substantial. So yeah, Berkshire averaged 2.8% above the risk-free rate, but it bounced a lot. I mean, it moved a lot. There's a lot of standard deviation. Same thing for the market. What this number tells you is, of Berkshire Hathaway's variance around its mean, so of all the times that Berkshire Hathaway bounced around its mean, only 14.6% of that bounce is explained by the bounce in the market around its mean. So Berkshire is bouncing around its mean a lot, and the market's bouncing around its mean a lot. But very little of Berkshire's variance around its mean is explained by the variance around the mean of the market. So taken together, all we can say is that Berkshire has a positive beta, but it's less than 1, which means it doesn't have a ton of systematic risk. Not very much of Berkshire's variance is explained by variance in the market. In other words, Berkshire's return doesn't move all that well in tandem with the market, but we also cannot say that Berkshire Hathaway is generating any sort of positive abnormal returns outside of the systematic risk. Last thing I want to show you for this assignment is how to shortcut the beta, and I'm going to do it this way. So if you calculate the covariance for these two variables, so the covariance of the x and y variables, then if you calculate the variance of the x variable, so let's do that real quickly. So let's calculate the covariance. You want to calculate the covariance of a population. So here's the y variable, and we also need the x variable. And then let's calculate the variance of a population for the x variable, which is our market minus our risk-free rate, the equity risk premium. Okay, if you calculate the covariance and the variance, then the beta is simply the ratio of those two numbers, the covariance between the x and the y over the variance of the x variable. And you can see that that beta is the same as the beta that we got right here. So this is a shortcut way to get your beta. And you may want to format it just a little bit. Now, you may be saying, all right, who cares? Why are we shortcutting the beta? There's no reason to shortcut the beta. You just showed us how to estimate beta, Dr. Wright. Well, the thing of it is, what if this data changes? What if you update this data? What if this is only the last 5 years, the last 60 months, and you update it every month? Well, if you do the shortcut beta, then this beta will update automatically for you. But if you do it this way, then you have to go back through the point-and-click wizard using the Data Analysis tab. So this is just a way to shortcut that beta and get the exact same result. So again, Berkshire Hathaway seems to be outperforming the market on a raw basis. Doesn't have a ton of systematic risk, a pretty low beta. The variance around its mean of Berkshire's returns is not explained very well by the variance in the market return around its mean. However, sadly, we cannot say that Berkshire Hathaway is creating any sort of abnormal returns outside of systematic risk. So in general, Berkshire doesn't have a ton of systematic risk, but most of its returns are coming from systematic risk, or at least we can say that it's not generating any statistically significant returns outside of the systematic risk. Hopefully you understand the assignment, so this is what I need you to do. I need you to download the returns to Berkshire Hathaway over the same period that I did. Get the risk-free rate, get the return, figure out the y variable, which is just the difference between Berkshire's returns and the return on the risk-free rate. Figure out the x variable, which is coming straight from the FAMA French data set. Go ahead and estimate this regression. Highlight the important variables. Do some summary statistics over here and show me the shortcut beta. If you have any questions, as usual, you can contact me or you can contact any of the teaching assistants. Good luck. Hopefully it's not too bad for you.